rate hikes and rate cuts don't actually hit the market in entirety for like 6 to 18 months. So these rate cuts there is so much pressure. Imagine like...
We haven't even seen the effects of the Fed rate increases yet, fully.
Exactly, or maybe we're just now feeling those.
Right. Welcome to Loans Elevated, the podcast that brings you the latest industry news, expert interviews, and insightful discussions that will help you stay ahead in this dynamic market. I'm your host, Broch Lassig, and I've spent years in the trenches of the mortgage industry, helping individuals and businesses navigate the complex landscape of real estate financing.
I'm your co-host, TJ Heidenreich, and together we'll cover a wide range of topics, from business strategies that skyrocket your success to mindset and motivation that fuel your growth.
All right, so what?
Do you have like notes or something?
Yeah, just AI.
Screenshot that and send it to me.
I think I could just talk and then you can backfill.
I'll just react.
Yeah.
I like that. That makes my job easier.
Yeah, or you. Yeah, anyway. All right, so we're talking about the Fed rate cuts and the market reaction to that, how that's affecting the mortgage market, kind of what we're foreseeing going into the future, and maybe we can talk about our opinion on how that might impact the housing market in general. But what happened yesterday, so December 18th, what happened was the Fed chose to cut rates by a quarter point, the Fed funds rate by a quarter point, just exactly as expected. However, the major issue that came to pass, despite them cutting exactly as the market expected, the issue that came to pass was their expectations for future rate cuts got slashed in half. So they expected 4 rate cuts next year, and now the expectation is only 2 rate cuts. And inflation concerns increased. So they were originally expecting inflation to settle out around, I think, 2.1%. Now projections say 2.7%. So we're seeing a slight resurgence in inflation, which has them concerned. But then they also mentioned that labor markets are softening. They are softer than they were pre-pandemic. So 2019 era, the labor market is in worse shape than it was back then. So we saw a sell-off not only in mortgage rates, meaning mortgage rates got worse despite the Fed cutting rates. Mortgage rates got worse because they said they're going to cut fewer times and inflation's going to surge. And high Fed funds rate and high inflation is the enemy of mortgage rates. But also the uncertainty and kind of the, like, not even clear sentiment on what the economy is going to do freaked out the stock market as well, and the stock market sold off. So it was kind of a weird one. Yeah. But that's a brief summary.
Which usually you see the opposite. You see if there's a sell-off in the stock market, usually they're investing in mortgage-backed securities, so you usually see rates go up.
Right, you see these almost that react inversely.
But they both kind of crap their pants yesterday.
Yeah. Which is crazy. And you know what's interesting? This is something I think important to bring up. So I was working with a client I guess it wasn't yesterday. It was the day before yesterday. And they were talking to a lender who had told them, well, we shouldn't lock in today. I was encouraging them to lock in, a day before yesterday. They said we shouldn't lock in today because the Fed is almost certainly going to cut rates by a quarter point. And if they do that, we'll probably see rates drop by a quarter point on the mortgage. We know how ridiculous that sounds, but so many people, even people in our industry doing our same jobs, think that the Fed cutting rates is a direct correlation to mortgage rates coming down, and it's not.
Doesn't work that way. Now, what you do see is like your HELOCs or your consumer debt, if it's variable,
instant.
Overnight, you'll see
credit cards, HELOCs.
You see rates go down by 0.25%, but not the case with mortgage-backed securities. In fact, that was already baked in. We've known for months now that there's going to be some sort of cut. I mean, there's at least a high probability of that. So it's already priced into the market, this cut.
Yep.
But and we've said this time and time again, what the market reacts off of is based off of what's said during the conference, which was
especially now when the certainty level is like, I think leading up to the Fed meeting, it was 98.8% likely that the Fed was going to cut a quarter point. The market already knew it.
Yeah, but if they would have thrown a curveball at us and lowered rates by 50 basis points.
Or didn't lower at all.
Right. But if they would have lowered by 50 basis points, then we would have seen rates come down because we would have been not expected.
Yep.
And the market would like that.
That's right. So it's just really based on what the expectations are, which is
Versus
why we're
what
seeing
happens.
this weird dynamic. And the markets don't know how to set their own expectations based on what Jerome Powell said in the.
What I thought was
conference.
interesting is that they mentioned that the labor markets are weaker now. You would think that would have helped more than it did, because labor markets, if it's not as strong, you would think then inflation's going to keep going down. But maybe if we didn't have that comment yesterday, then it could have been worse. Maybe I think rates got worse by a little over 0.1%. Maybe it had been 0.25% that they gotten worse, or 0.5%.
Yeah. Well, and it is weird. It's confusing. Like the labor market thing is weakening, but it's in decent shape. Is like
Right.
So it's like, what are you saying? Is the labor market bad, or is it not? Or is it not bad?
Yeah.
It's worse than 2019. So what does that mean? Well, it can't worsen any further. And if you listen to some of the nuanced statements, that's why we saw this weird, crazy reaction in the markets. But, this leads us to what happens next. And really, unfortunately, what I think happens next is a lot of what we've been seeing over the past, I don't know, maybe it's been nine to 12 months, something like that, where we're seeing rates improve a little bit, and then boom, they get back, they hike back up close to where they were, and then they improve a little bit and they hike back up. So we're seeing a rate improvement. If rates were peaked out here, we're seeing rates just slowly trickle down in a very volatile way. So like you see them here, and then they cut down, and it's like, all right, lock, and then bam, they
we'll
spike
insert
back up.
like a picture of our candlestick chart showing exactly this with mortgage-backed securities. I mean, it's crazy.
It's exhausting.
Every
but
day it's volatile.
So many people are banking on, well, I'm going to wait for rates to drop. The Fed's cutting rates, and we hear that from clients every single time. Fed's cutting rates, so I'm going to wait because rates are going to drop, and it's not going to happen. And what we're hearing now is a lot of uncertainty from the Fed, not a lot of guidance. They actually said, which is crazy to me, they said that they can, something to the effect of, Jerome Powell said, we can confirm at this point that we have avoided a recession. Which is nuts, because how do you, in the same statement, say we've avoided a recession, but
The labor
market is worse than it's been in 5 years, and inflation is going to go back up?
We've avoided it for now, but tomorrow could be something different.
Right. So the crazy thing is, so anyway, I got on a tangent there, but waiting for rates to come down before you buy a home is a losing proposition. Home prices went up on multifamily houses. I just saw this in Salt Lake. This was across Utah, actually, in the Board of Realtors. Multifamily houses, so condos and townhouses, went up year over year 10%.
Yeah.
10 freaking percent. And that's so much of what home buyers are buying today is that stuff. So say you were going to buy a townhouse at, $400,000. Well, in 1 year, that townhouse went from $400,000 to $450,000. Like, you are losing money by waiting. You're not spending $50,000 in additional interest, certainly not at that loan amount. So waiting for this fallacy that rates are going to fall is a poor choice, because we've clearly seen over a long period of time, no one can guess it. We don't know what in the world is going to happen. So the idea is get in the game.
Yeah. Well, and I'd say also have a smart game plan set up beforehand. Like when I run my pre-approval numbers with someone, it's always really conservative. Like in my consultation, we use a qualification rate. Like if rates are sitting, just for the sake of round numbers, if rates are sitting at 6.5%, I'm going to run numbers at 7% with that client, because in the time that I give them that pre-approval letter and they're out shopping, rates could go up in a matter of days.
Easy.
Yeah. So that way there's a little bit of risk mitigation there, where they're going in with numbers knowing that this is more worst case scenario. That way, not getting their hopes up and turning around once they're under contract and saying, oh, sorry, payment's higher by $150, $200 a month.
Right, which is a caution that you have to play, because there's so many lenders that won't do that.
Right.
They'll bank on the opposite, like that lender I was talking about that my client was talking to. They'll bank on the slight potential that rates are going to get better. And it's like, that's just not going to happen.
No.
Or it's very unlikely, and it's a foolish way to make decisions.
Well, they're playing with money that's not theirs.
Right.
Like, we've got to educate the clients in the best way possible.
Yeah.
And also, that's why I think it's important working with someone that knows what they're doing in terms of reading the charts and understanding this market, because it is very complex, but it's super situational. Sometimes we'll have clients that they go under contract and we lock immediately, or sometimes based off their situation, we don't lock immediately and we wait for some sort of news that's coming out that we know is going to be in our favor, that rates are going to react in their favor and they're going to save money.
And the difference is, I think what you said is like, I think every lender attempts to do what you just said.
Mm-hmm.
The difference is not every lender is studied and educated and knows what and we're not saying we're the best ever and oh my gosh, pat us on the back. But the fact is we spend, honestly, 1 hour a day, I would say at least 1 hour every single workday. So, what is that? 200 hours a year that we're spending
plus the
studying
one-off conversations.
the market.
I mean, this is kind of like our fun conversations.
Exactly. This is like our weird nerdy hobby.
But
But we're studying the market. Like we are understanding this. We're digging deep. And so it's something that we can really help with. But the other thing I was going to say that kind of circling back to the Fed's thought process here and kind of what might happen. And I guess I don't know. What I think is going to happen is rates are going to come down slowly. Home prices are going to keep going up. Those that get in now are going to be the benefactors of home prices going up. Those that wait are going to be sorely mistaken in that being a good idea because they're going to lose a bunch of money. And at some point, my belief is we're going to hit a recession. And that goes kind of to what I'm thinking with the Fed. The Fed really is stuck between a rock and a hard place. So recessions are really self-fulfilling. It's either, hey, we've claimed victory and the market's good, and the Fed kind of speaks that rhetoric to the markets, and the markets behave in a way that like, okay, cool, we're good, and they rally. So we avoid a recession. Whereas if the Fed said, we're going to hit a recession, or we're in a recession, or there's high risk for a recession, suddenly the markets behave in a way that creates a recession. So some of this, we may not be getting the full story. And the reason that's important is if and when we hit a recession, rates will fall off a cliff. It happens every single time. 35% from peak to trough, basically, we see during a recession. Once a recession hits, during and through a recession, rates fall by about 35%. It's a significant drop. We will see that at some point. At some point, like we're seeing the grassroots view of it, and we see clients calling us to refinance their 3% rates to cash out, to consolidate debt because the household can't afford it. We see people losing jobs. We see people income getting cut. We see, even in the industry, like there's almost no holiday parties this year. Like we see a lot that you go to restaurants. You can get in at a restaurant that normally requires reservations and there's no one freaking there.
That's true.
And it's the holiday season when normally it's packed. Like the reality is the economy's not as good as it's portrayed to be. And I mean, that's just my opinion based on what I'm seeing as an objective, just bystander.
I agree. And we're also seeing this in a strong pocket of the nation economy. So I can't imagine whether this is like another area.
Exactly. Utah's like the strongest of the strong. Yeah. So it's like, I think part of it is maybe, this sounds ridiculous, but maybe we're being lied to in probably with good intentions. They don't want to freak the markets out and create something that doesn't have to be created, like a recession. But I don't think we're getting the full data point. No. And at some point, the rates will fall. And when they do, we are going to see a violent pop in home prices. It's going to be like 2020, 2021 levels.
Do you think
there's so much pent up demand?
Do you think that's why they're also saying this though, to try and avoid that violent pop, because they don't want rates to fall too soon and have more inflationary data pop up because rates have fallen too soon?
Yeah, 100%. That's why. Yeah, they're balancing that scale. Yeah, and it's like how hard can they push? We've talked about this a few times, but
they're doing a poor job doing it because they're just creating this seesaw effect of mortgage rates going up and down.
It's a freaking pendulum going this way and then this way and then this way.
And no one knows what to expect.
Yeah, it's rough. And when we've talked about this, when we did this about a year ago in our market update, the effects of Fed rate hikes and rate cuts don't actually hit the market in entirety for like 6 to 18 months. So these rate cuts there is so much pressure. Imagine like
we haven't even seen the effects of the Fed rate increases yet fully.
Exactly, or maybe we're just now feeling those.
Right.
And so and we're at max level now. Like the Fed rate cuts just started, so we got another 6 to 12 months before those we even feel the benefits of those. So it's like imagine you're like working out and you're sitting under the squat bar. And you've got a bunch of, say you've got, 315 pounds on your back and you're squatting and you're like, okay, I'm done. But you have to stay squatted for an extra 2 minutes.
And add more weight or take some off before you get to rack it.
Before you get to lift up, but you were already done. That's like what the market's going to experience, because the market, we're clearly tapping out with the employment getting weaker inflation is kind of stalled. Like the economy's tapping out.
Mm-hmm.
Yet the same weight is going to be on the economy's shoulders for months to come. At some point, something has to break.
Right. It'll also be interesting to see how markets react too once we see the president-elect be going to office and all of his parties.
There could be
see
some
how
major drama.
Right.
Because he's even threatened to fire Jerome Powell.
Exactly. So,
which it sounds like he technically can.
Who knows how the markets will react based off that. I think it's kind of a coin
insane.
flip.
Yeah, and that might be also why Powell is doing what he's doing. This like, whether we like it or not, this could be some posturing. Because one thing they said in the remarks in the meeting was, we are now baking in, this is why some of the inflation went up, we're now baking in the risks of tariffs and what that does to inflation. So the Fed is kind of doing a dangerous thing where they're blending politics. They're blending forthcoming potential politics, not even anything that's real yet, into their forecasts and programming the markets and the economy in a way based on assumed potential things that happen in the market. That's not what the Fed's job is.
Right.
And it could be leading us astray.
They're using data that's lagging for 6 to 12 months and politics that are in the future for a couple months. So
and who the hell knows if Trump can even get these tariffs passed?
Right.
Like, who knows if it even happens?
Right.
Yet we're programming the market in a way that, like, and that's my worry, is I think we're walking on thin ice, and the Fed has a blow dryer out with some of their actions, and it's like that ice just keeps getting thinner.
Yeah. No, for sure. Well, it's going to be interesting to see how this all plays out. Yep. We'll be here along the way, and we'll keep you guys updated.
Yep. Well, that's summary. Thanks for tuning in.
Thank you for tuning in. For more industry insights, follow us on all platforms at Loans Elevated.
And to get in touch with our team, call or text 801-713-4000 or visit loanselevated.com.